Welcome back to the Deep Dive. Today, we have a mission. We're going to try and reconcile one of the most, I think, frustrating paradoxes out there for investors right now.
It's a big one. We're diving into Costco Wholesale, ticker QST.
Right. And if you follow the market, you've probably seen two completely conflicting facts about this company.
Exactly. On one hand, you have the business itself, and our sources just confirm it is executing, flawlessly. They just posted these phenomenal Q1 results that should have investors, popping champagne.
They really should. The business momentum is just massive.
Yeah.
But, and here's the hook for our whole deep dive today, despite all that, the stock is just, well, analysts are calling it stuck in the mud.
And they're not wrong. It's down nearly 5% year to date. Over the past year, it's lagged the market pretty badly, dropping around 11%.
So that's a contradiction. How can a business that is so clearly winning, beating expectations, taking market share, how can its stock just completely stall out?
That is the mission today. We've dug deep into the Q1 earnings reports, the analyst calls, the valuation reports, all of it. We want to understand why the business is so strong, but the stock is being held back by, well, its own incredibly high price tag.
Okay, let's unpack that. I think we have to start with the operational side of things, the sales engine. Because if you just looked at these Q1 numbers in a vacuum, you'd think this was the best company in the world.
You absolutely would. It's not just that the momentum continued, it really feels like it accelerated. Total revenue in Q1 jumped 8%.
8%. To what final number?
$67.31 billion. And that landed, very comfortably ahead of what Wall Street was expecting.
And what about the profit side, the earnings?
It followed suit. Adjusted EPS earnings per share, that rose 11% to $4.50.
$4.50. And for you listening, just to put that into context, that wasn't just a small beat. The analyst consensus was sitting at $4.27. So a really definitive beat on both the top and bottom lines.
But here's where the story gets, I think, really compelling. It's in the comparable store sales, the comps.
Right, because that shows you the health of the actual existing stores. It strips out all the noise from new openings or, gas prices and currency swings.
Exactly. It's the true pulse of the business.
Yeah.
And worldwide, their comps grew by a remarkable 6.4%. The U.S. was very strong at 5.9.
And I saw one market that was just on fire.
Oh, yeah. Canada was the absolute standout. Comps there climbed an impressive 9% on an adjusted basis.
9%, wow.
But the really crucial thing here is to connect this to the bigger retail picture. This is where you see just how dominant they're becoming.
Because that growth isn't happening in a vacuum. They're clearly outpacing their rivals.
Every single one of them. Take that 5.9% U.S. comp growth. Now think about Walmart. Their U.S. comps were up 4.5%. Good, but not Costco good.
And what about Sam's Club, their direct competitor?
Sam's Club saw 3.8%. And then you look at a company like Target, which is really struggling. They actually reported a comparable store sales drop.
A drop.
A drop of 2.7%. So the message from the market is just crystal clear. Costco isn't just growing, it's aggressively taking market share from everyone else.
That kind of performance really does speak to just incredible operational resilience.
Yeah.
And I always find it interesting to look at what people are buying because it tells you something about the consumer right now.
For sure. And we saw really robust performance in their core categories. Fresh food sales were up in the mid to high single digits.
And meat, that's a big traffic driver for them, right?
A huge one.
Yeah.
And meat sales had another quarter of double-digit comp sales growth. Just incredible consistency there.
But the insight that really jumped out at me was in the non-food categories. People aren't just buying groceries.
No, not at all. Non-food also rose strongly, and it was led by double-digit gains in, of all things, gold and jewelry, and also health and beauty.
Gold and jewelry. That's amazing.
It really is. It speaks to the power of that membership model, The trust is just so incredibly high that customers are happy buying their everyday shampoo. And in the same trip, making a huge discretionary purchase like a gold bar.
They just see Costco as the ultimate stamp of approval on value, no matter what the product is.
Exactly, the final arbiter of value.
And that idea of trust flows right into their digital business, which, let's be honest, is an area where a lot of these big box retailers tend to lag. But Costco seems to be making a really successful leap.
Oh, it's more than a leap. The figures here are just staggering. Digital revenue surged 20.5% in Q1.
20%. And what about traffic? Are people just buying more expensive things, or are more people actually showing up online?
More people are showing up. Traffic to the site climbed 24%, and maybe even more important for the bottom line, the average order value was up a very strong 13%.
And the app. I saw a number for app engagement that just blew my mind.
The app traffic soared 48%.
48%. That is a massive, massive surge.
It is. And this didn't just, happen by accident. The sources are pretty clear this was the result of some very specific tactical improvements they made.
What kind of improvements?
They really focused on making the digital experience better. Things like much improved search functionality, better display pages for products, and they rolled out personalized product recommendations.
So they're finally using that shopping history data to make the online store smarter.
Exactly. They're moving away from just being an online list of bulk goods and toward being a really optimized, modern digital retailer. It's like a tiny, personalized warehouse in your pocket.
And we saw that this new infrastructure really held up under pressure, right? There's an anecdote about Black Friday.
Yeah, a record Black Friday for their e-commerce. They hit $250 million in non-food orders alone.
Incredible. But look, as important as digital is becoming, we have to pivot to the thing that truly defines Costco's entire business model, the foundation.
The membership, the fee revenue. That's the high-margin engine that separates them from, almost every other retailer on the planet.
And that engine is running very, very hot.
It is. Total fee revenue jumped 14% year over year, reaching $1.3 billion for the quarter. Now, we should be clear, that was helped by a recent price hike.
Of course. But that revenue is just so powerful for them financially, isn't it?
It's the whole game. That fee revenue is almost pure profit. A price hike is basically 100% gross margin. That money just falls directly to the bottom line and acts as this huge buffer against inflation or other costs.
So with the fees going up, let's drill down on the customers themselves. How loyal are they? How sticky is this base?
Well, the sheer volume is impressive on its own. They're at 81.4 million paid households. That's up over 5%.
But the real story, as always with Costco, is in the quality of that base. It's about the executive members.
That's the high-value segment, yeah. These are the customers who pay more for their membership, but they get a 2% rebate on their purchases. And that group, that cohort, jumped 9.1%.
How many members total?
They're at 39.7 million executive members now.
Okay, so this is where we get to the core strength of the model, but maybe also a hidden risk. Tell us what that executive member cohort means for their total sales.
This is the crucial insight from the reports. These executive members, they make up just 49% of the total paid memberships, so less than half the customer base.
Less than half, okay.
But they account for a massive 74.3% of Costco's entire worldwide sales volume.
Wait, let me get this straight. Less than half of the members are driving almost 3/4 of all the money they make.
Precisely. They're the high-frequency, high-value shoppers who are, for all intents and purposes, the entire business.
That is an incredible reliance on one group of customers. So with that in mind, how are the renewal rates looking? Are we seeing any cracks in that loyalty?
The rates are still exceptionally high. I mean, 92.2% in North America, almost 90% worldwide. These are numbers other companies would kill for.
But I hear a bud in your voice.
But the sources did note one small issue, a strategic question for the future. Those incredible rates were slightly impacted by lower renewals from one specific group.
Which group?
Younger consumers, specifically younger consumers who sign up through their digital channels.
Oh, that is fascinating. So the very channel that's driving that insane 48% app growth is also bringing in a customer who's a little less sticky.
A little less loyal than that traditional walk-the-aisles warehouse shopper.
Exactly.
It's a classic acquisition versus retention challenge.
And Costco knows this.
Oh, yeah, they're all over it. They're already working on targeted communication, new ways to talk to these younger digital members to try and keep them engaged and stabilize those rates. The pressure is on, to turn that digital convenience into real long-term loyalty.
Okay, so that brings us right back to the central question. We've established, I think pretty clearly, that this is an operational powerhouse. They're dominating their competitors. They're mastering e-commerce. They have this incredibly loyal, high-spending core customer.
The fundamentals are, as close to flawless as you can get.
And yet, we come back to the paradox. The stock has gone nowhere for a year. What is the core explanation? Why is this juggernaut stuck in the mud?
The answer is frustratingly simple for anyone holding the stock right now. It's one word. Valuation.
The price.
The price. The market has priced Costco for absolute flawless perfection, not just now, but well into the future. The stock's forward price to earnings ratio, the PE, is sitting at a hefty 43.5 times.
Okay, 43.5. We really need to put that number into perspective for people. What would a normal, even a very successful top-tier retailer trade at?
I mean, 43.5 is just astronomical for a mature retailer. A company like Walmart often trades in the low to mid-20s. Target, even when it's doing well, is maybe in the mid to high teens.
So we're talking double or even close to triple the valuation of its peers.
Easily. Even historically, Costco itself usually traded in a range between 30 and 40 times earnings. We are currently demanding a level of performance that is far beyond even its own historical norm.
So what the market is saying is not just that Costco is the best retailer. The price is demanding that it performs literally twice as well as a giant like Walmart, just to justify the price it's at today.
Precisely. Which leads to the obvious question. Why? Why did the market give it such a huge premium in the first place?
Right. What's the logic there?
It all comes down to the perceived moat, the safety and the resilience of the business model.
The moat being the thing that protects them from competition.
Exactly. And for Costco, that moat is the stickiness of the membership. During all the uncertainty of the last few years with high inflation, investors just flocked to companies they thought had pricing power and, a lock on their customers.
And Costco is seen as the ultimate inflation hedge.
The ultimate hedge. The thinking is, no matter how bad the economy gets, people still need to buy groceries, and they will pay that annual fee to get the best value. That consistency, that perceived safety, that's what drove the premium to these incredible heights.
That makes perfect sense. The market pays more for stability when everything else feels volatile. But the conclusion from our sources then is that all this amazing operational performance we just talked about.
Right. The huge sales, digital leap.
That is now just the price of admission. It's required simply to maintain this sky-high valuation, not to actually push the stock any higher.
That's the trap. The incredible operational growth now needs time to catch up to the valuation. The business has to grow into its own price tag. And until earnings grow enough to make that 43.5 PE look more reasonable, analysts predict the stock will be range-bound over the next year.
You're paying today for profits that Costco won't actually make for quite some time.
A very difficult position for an investor.
And just to round out the full picture, they are still growing physically, right? They're still opening new warehouses.
Oh, absolutely. They opened 8 new locations last quarter alone. They did adjust their outlook for the full year down slightly to 28 new stores, but that was mainly due to some construction delays in Spain.
So the plan is still aggressive growth.
Yes, they're still planning for 30 or more new stores in the coming years. The physical expansion is chugging right along. But the financial valuation, that's the bottleneck. That's what's holding the stock price back.
Okay, so let's synthesize this for everyone listening. What have we learned? Costco is, without a doubt, an operational powerhouse. It's gaining market share, it has a booming digital business, and it's all driven by these incredibly valuable executive members.
The fundamental business metrics, sales, traffic, loyalty, are absolutely flawless. They're crushing the competition. But the one metric that's keeping the stock flat is its towering PE ratio, sitting at 43.5 times forward earnings.
It's a company that is, in a way, a victim of its own success and an incredibly high expectations that success has created.
That's a perfect way to put it.
Which brings us to our final thought for you to chew on. We learned that the huge 48% surge in app traffic is bringing in a new kind of customer. Younger, digital native members who have slightly lower renewal rates. And this is forcing Costco to figure out new ways to communicate with them to build loyalty.
And that raises a really important question about the future. Given the massive, explosive success of the digital channel, how long until Costco's very identity begins to subtly shift?
What do you mean by that?
I mean, how long until we stop thinking of them as a warehouse club that just happens to have a website and start seeing them as a digital-first retailer whose main mission is to keep members loyal through online personalization and convenience?
Rather than just relying on the treasure hunt experience you get from walking around a giant physical store.
Exactly. When does the digital tail start wagging the physical dog? It's a question of brand identity, and it's something to think about as this incredible business works hard to grow into its massive price tag.
A great question to ponder. That's all the time we have for this deep dive. We'll see you next time.